Welcome back, listeners. Today, we're diving into a fascinating topic. Has Canada's housing market hit a turning point? After months of muted activity, it seems the gears might be shifting, thanks to some significant changes in interest rates. The Royal Bank of Canada economics team has reported a notable rise in home resales for October. Early data from local real estate boards show strong gains in major cities compared to September levels. This uptick is largely attributed to a cumulative 125 basis point cut by the Bank of Canada. According to RBC analysts, this rate cut has been the catalyst many buyers were waiting for. Throughout the year, we've seen a rise in inventory, which has opened up more options for buyers. This additional choice has motivated many to enter the market. However, despite the increase in available homes, demand has outpaced new listings in several major cities, creating tighter conditions. In cities like Toronto, Vancouver, and Victoria, which were previously more buyer-friendly, the balance has shifted. Sellers are gaining more bargaining power. Prices, however, have not reacted as dramatically. The multiple listing service home price index remained relatively stable in October, with only slight increases in Toronto and year-over-year price declines in Vancouver, Victoria, and Toronto. Meanwhile, Calgary, Edmonton, and Montreal are solidifying their positions as seller-favorable markets. RBC's Assistant Chief Economist Robert Hogue and economist Rachel Battaglia suggest that October could mark an inflection point in Canada's housing market recovery. They anticipate another 50 basis point cut in December and additional reductions in 2025, which could keep the momentum going. Nonetheless, affordability remains a significant concern. October brought a noticeable boost in Toronto's market activity, with a 14% increase in resales from the previous month. This marks the highest level of activity since January. While the uptick in inventory has helped stabilize prices, condo prices remain under pressure due to a surge in new completions. This influx has given buyers in the condo market significant leverage, with the condo benchmark dropping 6.1% from a year ago, while single-detached homes saw a smaller decline of 2.5%. RBC points out that housing affordability is extremely strained in the Toronto area and will remain a significant obstacle for many potential buyers. However, the lower interest rates should bring some relief and help sustain the market's recovery in the coming months. In Montreal, the recovery trend is accelerating. Resales grew over 6% in October after steady increases in the previous months. With listings unable to keep pace with sales, prices have seen moderate gains. For instance, single-family homes sold for a median of $589,000 in October, an 8% rise from last year, while condo prices reached $414,000, up 5%. Montreal's market is on track to return to pre-pandemic sales levels if the current momentum continues. Turning to Vancouver, October marked a notable shift with home resales rising 22% month over month, the strongest performance in over a year. This surge brought Vancouver's sales activity to a 17-month high, signaling a potential rebound after a period of tepid growth. The sales-to-new listings ratio has crossed over the balanced threshold, giving the market more stability and setting the stage for modest price appreciation. Nevertheless, high inventory levels continue to weigh on prices, with the MLS Composite Home Price Index still 1.9% lower than it was a year ago. Calgary's housing market has remained resilient, even though it didn't experience the same level of growth as other major markets. Home sales have stayed about 50% above pre-pandemic levels, driven by steady demand. The market is firmly in sellers' favor, with resale activity outpacing new listings for the first time since June, resulting in a slight tightening of market conditions. Price growth has started to slow, with annual gains moderating to 4.5%, the lowest rate in over a year. RBC economists project that additional interest rate cuts in the coming months will keep demand and prices on the rise. It is crucial to keep a close watch on these developments as they unfold, as they will undoubtedly shape the future of Canada's housing market. Today we're taking a closer look at some new developments in the Canadian real estate market that could impact home buyers in the long run. Recently, the Bank of Canada's Senior Deputy Governor Carolyn Rogers cautioned that while new mortgage rules might make it easier for younger buyers to enter the market, they could end up paying significantly more over time. According to Rogers, These relaxed mortgage rules allow borrowers to stretch their mortgage payments over 30 years instead of the usual 25 years. While this can reduce monthly payments by about $200, it could also mean an additional $50,000 in interest costs over the lifetime of the mortgage. This is something potential buyers need to weigh carefully. Moreover, Rogers noted that lenders might face increased risks if homeowners encounter financial stress down the line. It is crucial for both borrowers and lenders to consider the long-term implications of these new mortgage terms. In another piece of news, the aftermath of Donald Trump's recent United States election win has caused a rally in stocks and cryptocurrencies. However, personal finance columnist Rob Carrick warns that this could be a diversion from underlying financial challenges. Investors have sold off United States Treasury bonds, leading to higher bond yields, which affect mortgage rates here in Canada. Although mortgage rates have fallen from their recent peaks, they are still significantly higher than where many homeowners locked in a few years ago. The current bond market trends suggest that further cuts in mortgage rates might not be imminent, which is an important consideration for those waiting on the sidelines for lower borrowing costs. On a more positive note, Toronto's real estate market saw a significant uptick in October. The Toronto Regional Real Estate Board reported a 34% increase in transactions from October of last year, marking the highest volume since January. This resurgence is attributed to a larger interest rate cut by the Bank of Canada and the introduction of the new mortgage rules. Meanwhile, in Vancouver, there's a mix of excitement and concern as the city moves forward with its plan to create urban villages. This initiative is part of Vancouver's strategy to rezone 17 intersections for higher density living, allowing for residential buildings up to 6 stories without lengthy rezoning processes. While this could alleviate pressure from larger 20-story towers, there's worry that it might erase the unique character of certain neighborhoods. Finally, for our Home of the Week feature, we have a charming Cape Cod-style residence at 127 Oceanstone Drive in Lunenburg, Nova Scotia. This 3-bedroom home, once owned by a member of the Canadian Tenors, offers breathtaking ocean views and a taste of small-town life. With an asking price of $1.97 million, it's a serene retreat for those who appreciate coastal living. Midwestern Ontario's real estate market is experiencing a remarkable resurgence. The multiple listing service system of the One Point Association of Realtors reported a significant increase in home sales in October. Specifically, 238 homes were sold in Grey, Bruce, and Owen Sound, marking a 32.2% rise from the same month last year. Meanwhile, the Huron-Perth area saw 191 units change hands, representing a notable 44.7% increase compared to October 2023. The One Point Association of Realtors, which amalgamates several local real estate associations, serves nearly 3,000 real estate professionals across regions, including Huron, Perth, Grey, Bruce, Wellington, Georgian Bay, and beyond. According to Bonnie Luby, president of the association, the sales activity in Huron-Perth has exceeded expectations, making it the 5th best October in history for the region. Luby noted that sellers have responded to this surge in buyer interest by listing homes at a record pace. Luby explained that while demand has surged, the balance of inventories has shifted downward, cautioning that 1 month does not establish a trend. The association plans to monitor the market closely to see if the influx of buyers continues and how sellers might react. In Grey Bruce and Owen Sound, the market momentum from September continued into October, bringing sales back to typical levels for this time of year. In terms of new listings, October saw a nearly unprecedented increase. In Bruce, Grey, and Owen Sound, new residential listings rose by 10% compared to October 2023, with 428 new listings. This was the highest number of new listings for October in over 3 decades. Similarly, Huron-Perth experienced a 14.5% increase in new listings, with 308 residential listings, marking the largest number ever for October. These figures were significantly above both the 5-year and 10-year averages. Despite the high number of new listings, active residential listings also saw a notable increase. Bruce, Grey, and Owen Sound had 1,374 active listings by the end of October, a 13.2% rise from the previous year. Huron-Perth had 795 active listings, up by 21% from last year. These are the highest active listings for October in more than 5 years for both regions. As for home prices, the multiple listing service Home Price Index composite benchmark in Huron-Perth was $584,400 in October 2024, reflecting a 4.3% gain compared to last year. In contrast, the benchmark price in Grey, Bruce, and Owen Sound was $571,000, a slight decrease of 0.6% from October 2023. This suggests a nuanced market, where some areas are seeing price increases while others experience slight declines. Let's delve into the current dynamics of the Greater Toronto Area's real estate market, where a recent report reveals that 70% of homes are still selling for below the list price. This trend persists despite an increase in sales activity throughout October. The Toronto Regional Real Estate Board has observed a rise in both sales and prices in several areas. For instance, Mississauga experienced a 3.2% increase in the average home price, reaching $1,081,951, with sales up by 27%. Interestingly, the Greater Toronto Area witnessed a month-over-month climb in home sales during both September and October for the first time since the pandemic's peak in 2020. This uptick is largely attributed to the Bank of Canada's interest rate cuts, which have seemingly invigorated market activity. However, as Wahi CEO Benji Kachin points out, the real test will come with next year's spring market, as it's still too early to fully assess the long-term impact of these rate cuts on the GTA's real estate scene. In October, many buyers managed to secure homes for less than the asking price, with 70% of all transactions across the GTA falling into this category. Wahi's report highlights that 88% of neighborhoods with at least 5 home sales were in underbidding territory. This figure is consistent with September's 86%, but represents an increase from 81% a year ago. The underbidding phenomenon is particularly prominent in upscale neighborhoods, such as those in Mississauga and Oakville, where home prices range from $2 million to over $4 million. Eastlake in Oakville, known for its unique custom homes, frequently appears among the top underbidding neighborhoods. The challenge in pricing these unique properties may contribute to inflated list prices, leading to underbidding. Conversely, neighborhoods with homes priced in the low to mid $1 million range, particularly in Toronto and Markham, are seeing more overbidding. Wahi notes that both underbidding and overbidding can be influenced by seasonal factors and strategic low list prices intended to ignite bidding wars. However, as we approach the quieter winter months, competition is expected to taper off. At the end of each month, Wahi analyzes the median differences between list and sold prices to determine whether neighborhoods fall into overbidding or underbidding categories, excluding areas with fewer than 5 transactions. In October, 307 neighborhoods met this threshold, up from 284 in September, providing a comprehensive overview of the market's current state. Let's take a moment to examine the current situation surrounding fixed mortgage rates in Canada and how they are intricately linked to the U.S. bond market. Fixed mortgage rates in Canada are closely tied to the fixed income market rates, which in turn follow the trends of the U.S. bond market. There's a strong correlation, about 0.95 statistically, between 5-year American and Canadian bond yields. This means that movements in the U.S. borrowers' bond market often mirror in Canada. Recently, there's been a significant uptick on the United States side, with the 5-year Treasury yield surging by 65 basis points. In contrast, Canada's 5-year yield has lagged somewhat due to a weaker economy here and the challenges of high living costs and debt levels. Despite the doom and gloom predictions about Canada's economic prospects, it's important to remember that these concerns often look backward rather than forward. As Shelley Kaushik from BMO Capital Markets noted, the old adage that what's good for the U.S. economy is good for the Canadian economy still holds true. The U.S. economy was the fastest growing in the G20 last quarter, with a growth rate of 2.8%. Unemployment in the U.S. remains low, and economic indicators for both countries are pointing upward, signaling potential expansion. However, there's a twist in the narrative with the recent political developments in the U.S. Donald Trump's return to the political scene, coupled with a likely Republican control of Congress, brings a mixed bag of potential economic impacts. While some fear increased spending and deregulation could lead to inflationary pressures, others see opportunities for economic growth. This potential for increased inflation is one reason why bond yields have been rising. Trump's policies might include ramping up spending, cutting regulations, and imposing tariffs, all of which could affect the Canadian economy. Moreover, the Federal Reserve's stance on inflation is cautious, with Chair Jerome Powell indicating limited further easing. This has led economists to adjust their forecasts, expecting less aggressive rate cuts in the coming years. For Canadians, this means the outlook for fixed mortgage rates is becoming less predictable. The possibility of higher fixed rates, or at least stable rates in 2025, is now more likely. While some Canadians might be hoping for a significant drop in fixed rates to refinance or purchase homes, the reality is that such a drop seems less probable now. In light of these uncertainties, fixed rates close to 4% for terms of 3 to 5 years might be a wise choice for those who value stability. Alternatively, a hybrid mortgage could offer a balance, allowing borrowers to decide how much risk they want to take with variable rates. As the future remains uncertain, spreading your bets could be more prudent than going all in on one option. Today, we're turning our focus to some significant developments in Toronto's real estate sector, particularly the city's push to unlock 20,000 new rental homes. This initiative is a robust response to the ongoing housing supply challenges, aiming to deliver 4,000 affordable units through a mix of incentives and partnerships. The city's strategy includes sweeping financial incentives such as indefinite development charge deferrals and substantial property tax reductions. The initial phase involves the approval of 7,000 rental homes, with further progress dependent on increased federal and provincial funding. Meanwhile, the Building Industry and Land Development Association, or BILD, is calling for a broader strategy to tackle the rising construction costs in Toronto. BILD's president and chief executive officer, Dave Wilkes, has emphasized that the current incentives mostly benefit city-led or federally subsidized projects, leaving many market units in limbo. Wilkes advocates for a collaborative approach involving provincial and federal governments to expand these incentives. Without such measures, the city risks exacerbating its affordability crisis well into the next decade. Looking at the broader Ontario housing market, the Canadian Real Estate Association is forecasting a nearly 10% increase in home sales for 2025. This anticipated surge is largely due to the recent rate cuts by the Bank of Canada, which have already sparked a significant boost in Greater Toronto Area home purchases this past October. Although the sales volume is expected to rebound, home prices are predicted to rise more modestly by 2.4%, suggesting a stabilization in the market. In transportation news, the Hamilton Light Rail Transit Project is making headway with the issuance of a request for qualifications for its civil works and utilities contract. This project, which will connect Eastgate Square to McMaster University, is expected to enhance connectivity for over 50,000 daily riders, easing traffic congestion and fostering economic growth in Hamilton, one of Ontario's rapidly expanding urban areas. As we approach the holiday season, industry professionals can look forward to several key events. The Buildings Show in December will host over 18,000 attendees at the Metro Toronto Convention Centre. This event is Canada's largest gathering for construction and real estate professionals, offering a wealth of knowledge and networking opportunities. Additionally, the Build Women's Luncheon on November 13th will feature Olympic gymnast Rosie McLennan, providing an inspiring platform for women in real estate and development to connect and share insights. Finally, the Concord City Place development has been recognized with the 2024 Award of Excellence in the Urban Habitat category by the Council on Tall Buildings and Urban Habitat. This award celebrates the transformation of Toronto's former railway lands into a vibrant mixed-use community, which now houses over 30,000 residents in more than 30 towers. The development includes green spaces, retail hubs, schools, and community centers, showcasing an exemplary model of urban planning and community building. Today, we're spotlighting a significant financial development that promises to inject new life into the agricultural sector across Western Canada and Ontario. Farm Credit Canada, in partnership with Glengarry Farm Finance Corporation, is delivering a $60 million cash injection aimed at providing farmers with much-needed financial flexibility. This partnership is not just a financial transaction, it's a lifeline for many farmers who form the backbone of Canada's food supply. Farm Credit Canada, a leading agricultural lender and Crown Corporation, recognizes the unique challenges faced by farmers and is committed to supporting them through this substantial investment. The funding will be managed by Glengarry Farm Finance Corporation, a specialized agricultural lender known for its flexible financing solutions, tailored to the needs of farmers who might not qualify for traditional bank loans. Tara Sturkin, head of marketing and business development at Glengarry, explained that the cash injection includes $40 million upfront with an additional $20 million available, and potentially more in the future. This funding allows Glengarry to offer more competitive rates, effectively closing the gap between prime lending rates and private commercial lending. This is crucial as it provides farmers with the opportunity to secure slightly longer terms without incurring prohibitive costs. Sturkin highlighted that this partnership allows Glengarry to engage in larger deals than before, expanding their capacity to support the agricultural community. Previously, they were limited to deals in the $5 to $7 million range, but now they can entertain even larger financial commitments, providing more substantial support to the farming sector. The importance of this partnership goes beyond finance. It's about reinforcing the essential role that farmers play in Canada's economy. As Sturkin put it, supporting fifth and sixth generation farmers is vital for sustaining the agricultural diversity that feeds Canadian families. This collaboration underscores a commitment to ensuring that these farmers have the resources they need to continue their invaluable work. In conclusion, this $60 million cash injection from Farm Credit Canada and Glengarry Farm Finance Corporation represents a significant step forward in supporting Canada's farmers. It's a testament to the pivotal role that agriculture plays in the nation's economy and the dedication to maintaining a sustainable and resilient food supply chain. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you are buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.